Thank you very much. Thank you very much, Kwame, for those reflections from the Institute of Economic Affairs. The key takeaway, I guess, is that we are grappling with what the IMF likes to call a fiscal trilemma. Domestic revenue is constrained, spending pressures are increasing, and the global markets are tightened. So even if you want to go and refinance debt, then you have a challenge, right? And that is why we had a stroke of genius in February this year when we had the preemptive refinancing of the 2027 note, which was maturing, and we had a May payment due this year. Our next speaker is our keynote speaker, Mr. Albert Mwenda. I like this gentleman for one reason. This is one man who understands the budget to the last digit. And trust me, I analyze the budget and I shoot questions and he responds. Let's appreciate Mr. Albert Mwenda as he comes. Director General, karibu sana.
Distinguished guests, ladies and gentlemen, good morning. You know, as of yesterday, we had not confirmed who was going to speak, but my friend Julian Zia really insisted that we must create time for this. But it's an honor to stand here before you. And I want to appreciate Kwame. You've set the base, and Bwana Kasimu. But I'll be speaking to some of those issues from our perspective. And first of all is to say that this summit comes at a critical time of the budget 2025-26 cycle, where we are at the approval stage of the budget documents that we submitted to Parliament. And whereas in the past we've had a process that was seen as not being very open, the Constitution of 2020 requires that we must prepare the budget in consultation with the general public. And therefore, such engagements with citizens and stakeholders are a prerequisite for us. And therefore, you will agree with me that our current approach marks a significant departure, and it fosters public participation, which is anchored in the Constitution. I want to appreciate this opportunity accorded to us in this summit by a very good partner, Nation Media. I know sometimes we may not agree, but it's in the service to the nation. And I do agree, we quite often engage with the Nation Media fraternity. We may take different views, but that's the nature of democracy. In my view, the theme that you have chosen today, in search of fiscal consolidation, challenges us to embrace fiscal discipline, and I see this as in 4 pillars. The first pillar requires that we must sustain our efforts to raise or to enhance revenue collection. That does not necessarily mean higher tax rates. Because that way then we are able to raise the required revenue to be able to finance the critical programs of government. Second is prudent spending. And prudent spending does not necessarily mean cutting costs. And I will be illustrating. And then third is sustaining robust structural reforms that seeks to improve the business regulation. And fourth is responsible financing of borrowing. Ladies and gentlemen, fiscal consolidation requires that we also pursue sound macroeconomic, or we establish a sound macroeconomic environment. And therefore, and I would like to just reflect on why this is important before I talk to the fiscal issues. As you are all aware, the economy has continued to strengthen. And that means that year on year, the economy has been growing in a very uncertain global environment, and in an environment that is characterized by frequent changes in weather that impact economic development negatively. We have registered an average growth rate over the last 3 years of 5.1% between the year 2022 and 2024, it was 4.9% growth in the year 2022, 5.7% in the year 2023, and last year we grew by 4.7%. Of course, this is above the global average and also above the growth in the sub-Saharan region. What does this tell us? It tells us that we have a diversified economy. A diversified economy is what gives resilience to the economy, such that when there are severe weather changes, then the economy can withstand, and we've seen that. Which are the sectors that have been driving this growth? First is agriculture, because of good weather, but we've also had a strong services sector growth. In the year that just ended, 2024, we had most of the sectors growing except construction and mining and quarrying. So construction contracted by 0.7%, while mining and quarry, although it's a small sector, contracted by 9.2%. Now, construction, we should keep that in mind, because there is a reason why construction is not growing. There were materials, construction materials that were affected, and I have in mind here cement, steel, and iron. And then we also had the low investment in the public sector. So what we do on the fiscal side has implication also on growth. So because we spent less in the road sector, for example, then our growth was affected. We are, however, projecting an improved growth in the 2025 2025 and 2026 of 5.3%. Driven by a robust services sector and agriculture, and also due to imports through the bottom-up economic transformation, for example, the sustained subsidies to inputs into agriculture. We also are projecting that the energy prices will continue trending downwards, and the investment in agriculture will see the food prices also trending in the right direction, and inflation therefore being contained. And with the lower inflation, we see a stable macroeconomic environment, and therefore also impacting less on our debt service costs, as happened in the past. Given the low inflation, you are all aware that the central bank has eased the monetary policy. We see that also having an effect on lowering of interest rates. The CBR rate was lowered from 12.5% in December 2023 to 10% in April 2025. The cash reserve ratio have also been lowered, thus releasing liquidity to the banks for on-lending to the banks. This has had an effect in the interest rates. The interbank rate is trending downwards, declined from 10.2% in April 2025 to from 13.7% in April last year. The 91-day Treasury bills has also gone down, and the others 182 and 364. Lending to private sector has also started trending upwards, although growing modestly by 0.2%, but it's an improvement from the contraction in February 2025 of 1.3%. This reflects a number of things. One is that the effect of the lagged effect of the depreciation of the shilling is now dissipating, and the effect of the easing of the monetary policy is also driving those rates downwards. Now, this has seen the lending to private sector rates, the lending rates to private sector, the lending rates by commercial banks decline to 15.8% in March 2025 from 16.4%, and we've seen improvements also in the current account balances. Exchange rate has stabilized, and we have accumulated significant forex reserves. Now, with that kind of environment, we think it provides a platform for us to pursue sustainable fiscal consolidation, because if there are no erratic movements in the interest rates and in the exchange rate, then the impacts on our fiscal the negative impacts on our fiscal plans is minimized. Now, turning to fiscal developments. Ladies and gentlemen, as you may be aware, revenue collection by end of March 2025 reflected a shortfall of 161.9 billion Kenya shillings, mainly on account of shortfalls in A&A of 142 billion, ordinary revenue of 142 billion, and shortfalls in A&A of approximately 19 billion. Now, total expenditures also were behind target by around 137.4 billion. These revenue shortfalls were as a result of a number of items. One is the social unrests that were witnessed between June and August last year that affected businesses. Second is the withdrawal of the finance bill. You will recall that we had projected to collect approximately 344.3 billion Kenya shillings in new revenue. That was not going to be possible with the withdrawal of the finance bill. There has been generally a slowdown in economic activity. As I said earlier, the economy grew by 4.7%, down from 5.7% the previous year, 2023. There has also been delayed disbursements and accumulation of pending bills. This reflects a delay in releasing of working capital to businesses, and therefore that translates to less revenue due to KRA. You may, however, recall that we introduced some additional measures through 4 tax instruments. There was the Tax Laws Amendment Act of 2024, the Business Laws Amendment Act of 2024, and the Tax Procedures Amendment Act of 2024 that was passed and assented to by December last year. We had anticipated that we would collect approximately 70 billion full year impact, but for the half year impact, that is between January and June 2025, we had projected to collect 49.9 billion. However, there has been some impact of those new revenue measures, but we are still lagging behind in terms of revenue collection, as I indicated, which means we had then to revisit our fiscal plan. You then recall, ladies and gentlemen, that following the withdrawal of the Finance Act, the Finance Bill 2024, there was a supplementary one that was introduced in Parliament. This was largely to correct for the persistent shortfall in revenue. As at end of December, we had reported shortfalls of about 93 billion against the target we had set. And as I have said, we have now shortfalls of about 161 billion as at end of March. So we introduced a supplementary budget, but that supplementary budget also cut expenditures. And the idea was to ensure that we don't carry a huge deficit and that we remain within realistic targets for both revenue and spending. We have also been facing pressure from a number of areas. One is a new education funding model. Second is the collective bargaining agreements entered with the trade unions. And third is the rollout of the universal health care. Universal health care. And even after implementing the first supplementary budget, we have had to introduce a second supplementary budget. One may ask why. At the point we were implementing, we were revising the budget last year, it was not clear how much or what additional revenue measures would manage to push through Parliament. And then second, it was not clear what the impact of the social unrest was by the time the bills were being approved, and the impact on economic activity. Having looked at the numbers and seen the impact of the new measures and the trend in revenue and the pressures in spending, we then reintroduced Supplementary 2, which projects ordinary revenue at 2.58 trillion for ordinary revenue, which is 14.8% of GDP. This is 50.5 billion less than what we had in Supplementary 1. In Supplementary 1, we had a projection of 2.631 trillion. And the total revenue was therefore projected at 3.067 trillion. Expenditures were revised to 4 trillion. That is 23% of GDP, given a deficit of 5.1% of GDP, which is in nominal terms, Kenya shillings, 887 billion. From a figure of, we had projected in Supplementary 1, a deficit of 4.3%. But because of the revenue shortfall and some pressures in spending, that fiscal deficit had to be adjusted upwards to 5.1% of GDP, to be funded by net external financing of 281.5 billion and a net domestic financing of 605.1 billion, or 3.5% of GDP. One may ask, after this revision, what is the outlook to the end of the financial year? We still continue facing some pressures on the spending side. We think that the deficit will edge up slightly. We are in the process. We have sent out a circular for Supplementary 3, and the idea is to be more realistic. As Treasury estimates as being ambitious or overly ambitious. Because when you look at the ratio of revenue to the size of the economy, the ratio has been trending downwards. So you remember some time back, we had revenue to GDP ratio of about upwards of 20%. We are now at below 20%, which means there is something that we are not doing right, and we still think we should target to make an improvement. And therefore, the Supplementary 3 is intended to revise the numbers to a more realistic level and ensure that we are not carrying forward. We are not making commitments that end up in pending bills carried to next financial year. This realistic revenue projection for 24-25 has also necessitated that we revisit the target for revenue. If you look at the budget policy statement that we had submitted, the revenue target was higher. We have revised that downwards. We now projecting ordinary revenue at 2.757 or 14.3%, and expenditures at 4.239.9 billion or 22.9% of 22% of GDP, giving a deficit of 4.5%. It is important to note that there is growing limited flexibility in the fiscal plan. What do I mean? If you look at, if you take ordinary revenues of 2.757 and domestic interest, foreign interest, and other mandatory expenditures like pensions and constitutionally mandated salaries, we have what we call consolidated fund services. We have a total of 1.33 trillion of those items, which the Constitution requires they must be paid. If you add transfers to counties, 405.1 billion, and salaries of about 950, plus earmarked funds in terms of CDF and affirmative action fund, the total estimated expenditures are about 2.77, whereas the ordinary revenue is 2.757. So you end up with a negative before you have even funded your other recurrent expenditures and development spending. So the budget is being prepared at a time when we are very constrained in terms of the fiscal space. Therefore, we have to be very strategic in where we direct our resources. Now, and that limited fiscal space is facing us at a time when we have to pursue fiscal consolidation. And therefore, in terms of how then we pursue this fiscal consolidation, there has to be space for enhancement of revenue. We have to enhance, pursue aggressive revenue mobilization. That, I want to repeat again, does not necessarily mean higher taxes. We have to be prudent in the way we spend. And we also have to be very responsible in how we borrow. And we have to pursue structural reforms that will help us contain public spending. On revenue mobilization, emphasis will be placed on a combination of factors. One is tax policy measures that aim to enhance efficiency and strengthening tax administration. The aim is to move our tax effort progressively towards the 20% of GDP into the future. How do we get there? First, we have to pursue strategies of broadening our tax base as provided for in the medium-term revenue strategy, reduce revenue leakages, enforce compliance, and minimize tax expenditures. This will be achieved through automation and digitalization at the Kenya Revenue Authority. Now, examples of how this can be achieved can be seen in the Finance Bill of 2025, where we have targeted measures like adjustments of personal income tax and corporate income tax benefits, and the recalibration of the VAT policies to reflect a careful balance between raising revenue while at the same time nurturing critical sectors. The objective is to create a tax system where enhanced revenue is not achieved at the expense of economic growth. Some of the measures include the increase in the daily subsistence allowance, not subject to tax for private sector, from Kenya shillings 2,000 to 10,000, exempting gratuity paid by public sector or private sector employers, allowing 100% deduction in the first year of use of all loose tools like utensils and linen, allowing deduction of mortgage taken to construct houses, advance pricing agreement to be developed by Commissioner General to enhance certainty and predictability in planning. Under NIFCA, the NIFCA certified companies will also enjoy a reduced corporate tax rate of 15% for the first 10 years, and reduced digital asset tax are among some of the measures that seeks to strike that balance, including exempting of inputs for animal feeds since their final product is exempt, and exempting packaging materials for coffee and tea, etc. On the spending side, we will seek to ensure that each investment, whether it's in education, healthcare, infrastructure, agriculture, social protection, and other better priorities, must be guided by a rigorous set of priorities that balances immediate needs with the long-term needs, as guided by the Medium-Term Plan 4 and Vision 2030. What will we be pursuing? Number one is pursuing or strengthening expenditure control. For example, through rationalizing non-essential expenditures, rolling out end-to-end procurement system, operationalizing public investment management system that will help better manage public investment by automating that process, and revamping public pension administration through a digital solution, and expediting state-owned enterprises, including privatization. To strengthen public finance management, government will also entrench zero-based budgeting. We are also fast-tracking the migration from cash to accrual and implementing the Treasury single account. To crowding private sector, we are pursuing a revamped PPP framework that will ease pressure on the exchequer and create an avenue for supporting commercially viable projects. We will pursue structural reforms, which involves overhauling outdated practices and embracing digital technology, building resilience through diversified growth, and reducing regulatory bottlenecks. On public debt, we will pursue debt operations that may involve acquiring cheaper debt to retire more expensive debt and lengthening maturities of both external and domestic debt. Our debt, although rated as high risk, still remains sustainable, and we believe, and we are allowed to take a different view. We still believe that what we have is a liquidity challenge and not a solvency one. I thought I should mention that. It is important to note the following: that number one, that the macros are still holding. Number two, the monetary policy is anchoring, is facilitating a conducive environment for both businesses and also for fiscal harmony. Number three, we have deep commitment to fiscal consolidation. And you can see we've come from highs of 8.2% of deficit, of 8.2% of GDP, to levels of now 5.1, and we are projecting to go further downwards. We have pressures, but we intend to contain those pressures. And we will sustain reform momentum in the areas that I have highlighted. We will pursue SOEs reforms, PPP reforms, and increased emphasis of agriculture sector support on production and continuous structural reforms to ensure that we contain our fiscal. And finally, is to say that we look forward to the feedback by citizens, including the stakeholders in this room, towards improving on our fiscal management going forward. And thanks to Nation Media Group for the opportunity to share. Thank you.
Thank you very much, DG. The only problem is that you came here with 10 pages, my brother. And now that you have cannibalized my time for